If you're a senior citizen living in the United States and you receive Social Security benefits, pension income, investment returns, or any other form of retirement income, there are critical new reporting requirements from the IRS in 2026 that you absolutely must understand and comply with to avoid penalties, missed refunds, and serious complications with your taxes. I'm going to walk you through everything you need to know about what the IRS is requiring seniors to report this year, why these requirements exist, who they apply to, what happens if you don't comply, and most importantly, exactly what steps you need to take to make sure you're meeting your obligations and protecting yourself from unnecessary problems. If you're new to my channel, please subscribe for more updates. The first thing you need to understand is that the IRS has been making significant changes to reporting requirements and enforcement priorities over the past several years, and many of these changes directly affect seniors, even though they might not be widely publicized or well understood by the general public. One of the most important changes relates to the reporting of retirement account distributions and how these distributions are taxed. In 2026, the IRS is placing increased scrutiny on required minimum distributions from retirement accounts, which are mandatory withdrawals that people must take from traditional IRAs, 401k plans, and other tax-deferred retirement accounts once they reach a certain age. The age at which required minimum distributions begin has changed in recent years due to legislation called the Secure Act and the Secure 2.0 Act, and there's widespread confusion about the current rules, which age applies to different people, and what the penalties are for not taking the required distributions. Under current law, as of 2026, the age at which you must begin taking required minimum distributions depends on when you were born. If you turn 73 in 2023 or later, your required beginning date for taking distributions is April 1st of the year following the year you turn 73. This represents a change from previous law where the age was 70 and a half, and then it was changed to 72, and now it's 73, with further increases planned for future years under the Secure 2.0 Act. The confusion around these changing age requirements has led to many seniors either taking distributions too early and paying unnecessary taxes, or failing to take distributions when required and facing substantial penalties. The penalty for failing to take a required minimum distribution used to be 50% of the amount that should have been withdrawn but wasn't, which was one of the harshest penalties in the entire tax code. The Secure 2.0 Act reduced this penalty to 25%, and it can be further reduced to 10% if you correct the error within a specific time frame, but even the reduced penalty is severe enough that you absolutely want to avoid triggering it. What this means for you in practical terms is that if you have money in a traditional IRA, a 401k from a former employer, a 403b retirement account, or similar tax-deferred retirement accounts, you need to know whether you're required to take distributions this year, and if so, how much you must withdraw. The amount of your required minimum distribution is calculated based on your account balance as of December 31st of the previous year, divided by a life expectancy factor from IRS tables. The calculation can be complex, particularly if you have multiple retirement accounts or if you inherited an account from someone else, which comes with its own set of distribution rules. Most financial institutions that hold retirement accounts will calculate your required minimum distribution for you and send you a notice telling you how much you need to withdraw, but you are ultimately responsible for making sure the withdrawal happens. The financial institution sends you the information, but they don't automatically withdraw the money and send it to you unless you've specifically set up automatic distributions. If you're new to my channel, please subscribe for more updates. This is where many seniors run into trouble. They receive the notice about their required minimum distribution, they set it aside intending to deal with it later, life gets busy or health issues arise, or they simply forget, and the deadline passes without the distribution being taken. Then they face the penalty, and they also face the administrative burden of filing IRS Form 5329 to report the missed distribution and request a waiver of the penalty, which requires explaining the reasonable cause for why the distribution wasn't taken. The IRS can grant waivers if the failure was due to reasonable error and you're taking steps to correct it, but going through this process is stressful and time-consuming, and there's no guarantee the waiver will be granted. The much better approach is to simply make sure you take your required distributions on time every year. The second major area where the IRS is requiring increased reporting from seniors in 2026 relates to cryptocurrency and digital assets. Many people assume that cryptocurrency is only relevant to young tech-savvy investors, but in reality, millions of seniors either own cryptocurrency directly or have exposure to it through investment accounts, and many seniors have received cryptocurrency as gifts from children or grandchildren or have invested in it themselves after hearing about its potential returns. The IRS has made it abundantly clear that cryptocurrency and other virtual currencies are treated as property for tax purposes, and any sale, exchange, or disposal of cryptocurrency triggers a taxable event that must be reported on your tax return. Starting with the 2025 tax year filed in 2026, there's a specific question on the front page of Form 1040 asking whether you received, sold, exchanged, or otherwise disposed of any digital assets during the year, and you must answer this question yes or no. Leaving it blank is not an option. If you answer yes, you need to report all your cryptocurrency transactions on your tax return using Form 8949 and Schedule D, the same forms used for reporting stock sales and other capital gains and losses. This means you need to know the date you acquired each unit of cryptocurrency, what you paid for it, the date you sold or exchanged it, what you received for it, and whether you had a gain or loss on the transaction. For seniors who purchased cryptocurrency years ago and have been holding it, or who received it as a gift and don't have clear records of its value at the time of the gift, assembling this information can be extremely challenging. For seniors who have engaged in multiple cryptocurrency transactions, perhaps buying and selling through an exchange or converting one type of cryptocurrency to another, the record-keeping and reporting requirements can be overwhelming.
The IRS is serious about cryptocurrency reporting, and they have been increasing their enforcement efforts significantly. The agency has been issuing letters to taxpayers they believe may have cryptocurrency transactions that weren't properly reported, and they have been pursuing audits and penalties in cases where they identify underreporting. The penalties for failing to report cryptocurrency transactions can include accuracy-related penalties of 20% of the underpayment of tax, and in cases of willful disregard, the penalties can be much higher. If you own any cryptocurrency, even small amounts, and you sell it, trade it, exchange it for other cryptocurrency, use it to purchase goods or services, or receive it as payment for anything, you must report it on your tax return. The only exception is if you simply hold cryptocurrency without selling or disposing of it in any way, in which case you would answer no to the digital asset question on Form 1040. The third critical reporting area for seniors in 2026 involves foreign financial accounts and foreign assets. If you have financial accounts in foreign countries, whether it's a bank account, investment account, pension from foreign employment, or any other financial interest in accounts located outside the United States, you may have reporting obligations that many people are completely unaware of. The main requirement is called the Report of Foreign Bank and Financial Accounts, known as FBAR, which requires anyone with foreign financial accounts that had a combined total value exceeding $10,000 at any point during the calendar year to file a report with the Financial Crimes Enforcement Network, which is a bureau of the Treasury Department. This report is filed electronically and separately from your tax return, and it has its own deadline of April 15th, with an automatic 6-month extension available if you need more time, though any tax due must still be paid by April 15th to avoid interest and late payment penalties. If you are new to my channel, please subscribe for more updates. Many seniors have foreign accounts for perfectly legitimate reasons. Perhaps you worked abroad at some point in your career and maintained a retirement account or bank account in that country. Perhaps you inherited money from a relative who lived abroad. Perhaps you or your spouse were born in another country and you maintain financial ties there. Perhaps you receive a pension from employment you had in another country before immigrating to the United States. Whatever the reason, if the total value of your foreign accounts exceeds $10,000 at any point during the year, you must file the FBAR. The penalties for failing to file FBAR when required are severe, with civil penalties that can be $10,000 per violation for non-willful violations, and the greater of $100,000 or 50% of the account balance for willful violations. The IRS and the Treasury Department have been actively pursuing these penalties, and they have been successful in court cases establishing that the penalties can be assessed on a per-account, per-year basis, meaning someone with multiple unreported accounts over several years could face penalties totaling hundreds of thousands of dollars or more. In addition to FBAR, there may also be requirements to report foreign assets on Form 8938, Statement of Specified Foreign Financial Assets, which is filed as part of your tax return. The thresholds for Form 8938 are higher than for FBAR and depend on your filing status and whether you live in the United States or abroad. But generally, if you have foreign financial assets exceeding $50,000 at the end of the year or $75,000 at any point during the year, you need to file Form 8938. There is overlap between FBAR and Form 8938 requirements, and you may need to file both reports for the same accounts, reporting the same information in different formats to different agencies. The complexity and the severity of the penalties make this an area where seniors absolutely need to be aware of their obligations and seek professional help if they have any uncertainty about whether they need to file these reports. If you are new to my channel, please subscribe for more updates. Remember that the deadline for filing your 2025 tax return is April 15, 2026, with an automatic 6-month extension available if you need more time, though any tax due must still be paid by April 15th to avoid interest and late payment penalties. If you're expecting a refund, there's no penalty for filing late, but you should file as soon as possible to receive your refund. If you discover an error on a return you've already filed, you can file an amended return using Form 1040-X to correct it, and if the correction results in additional tax owed, you should file the amendment and pay the tax as soon as possible to minimize interest charges. Your compliance with IRS reporting requirements is not optional, it's a legal obligation. And taking it seriously by understanding what you need to report and reporting it correctly will protect you from problems and ensure you're paying the correct amount of tax, no more and no less.